This is today's Market Pulse. The Bank of England has just announced its decision on monetary policy. We have no change in interest rates. They're kept on hold at a record low 0.5% as expected, and there has been no change to its asset purchase facility or bond buying programme. That's been kept at £275 billion. Well, let's go straight out to David Page, Senior Economist at Lloyds Bank in Corporate Markets. David, no change to QE. You had expected a minimum perhaps of £50 billion. Does this mean more QE is more likely or less likely next month?
I think there's no question as to whether or not they're going to provide more QE in February. We fully expect to see a further 50 billion extend beyond February. We are slightly surprised they haven't chosen to pre-announce that this month. The impression they've given in the minutes in both of the last meetings in December and November is not that they're considering whether or not the UK needs more monetary policy stimulus, but how they can provide it and when's best to see that come through. By not announcing until February, it means that QE purchase operations actually stop for a couple of days before they'll restart. And we thought that the MPC would like to try and smooth that profile a little bit. But clearly, we are still fully expecting not only 50 billion's worth of QE taking us from February through till May, but we expect a further 125 billion across the course of this year. So by the end of this year, we think they'll hold around 400 billion's worth of gilts.
So you're calling for 400 billion. Other forecasts are even bolder. Citigroup, for example, are expecting up to 600 billion. Whether it's 400, 500 or 600, what does QE on that scale do? What are the risks to not only the gilt market but the Bank of England's balance sheet itself?
Oh, there are a number of factors coming through. I mean, the scale of QE is entirely dependent on the scenario one places for Europe. Unfortunately, although there are brighter signs coming from the US, from China to some extent, we do think that if you see a significant deterioration in the euro area crisis, then clearly the UK GDP situation is looking a lot worse, and the monetary policy reaction will have to be stronger for longer. And therefore the risks of further QE are entirely dependent upon the economic circumstances at the time. Clearly at some stage there is a risk that however big the QE asset holdings are, we think at 400 billion, that if we see an economic turnaround, that increase in base money could feed through into a quicker increase in broad money growth. But with economic conditions staying very subdued at present, that clearly isn't happening for now.
David Page from Lloyds, thank you very much. Well, in around 40 minutes' time we will get the latest policy decision from the European Central Bank. It's widely expected to keep interest rates on hold at 1%, and we'll bring you the news conference with ECB President Mario Draghi at 13:30 GMT live. The focus, of course, is on what he says about extraordinary policy steps to contain the crisis, such as buying bonds. Well, let's get to the day's other top market stories. Massive moves on the Eurozone sovereign bond market. Yields on peripheral debt falling sharply after Spain's bond auction. Madrid raises €10 billion. That's double its target and means in one fell swoop, Spain has already met over 10% of its funding needs for the entire year. For more, I'm joined by Reuters bond market correspondent Will James. Well, quite incredible rally in these markets today. Italy and Spain, particularly Italy. Can you talk us through some of those moves?
Sure, yeah. I mean, Italy's down 10 years, down 50 basis points this week, 30 basis points today alone. That's not really what you'd expect because they've got a bond auction coming up tomorrow. These are big moves, but it only takes us back about a month or so, or back to where we were about a month or so ago. So in the grand scheme of things, not huge, but certainly very encouraging for tomorrow's sale.
And how sustainable is this rally?
Well, there's question marks over that. What we've seen is based on a lot of ECB money in the market. It's mainly at the short end. The sales have been at the short end. There are bigger tests down the road, and those will be longer dated bond auctions, which Spain has coming up, we think, next week. So.
Okay, Will, thank you very much. Well, that was today's Market Pulse. Join me at noon GMT every weekday for your daily Market Pulse fix, where we analyse the big market movers of the day. I'm Jamie McGeever. This is Reuters.